Welcome to the Three Edge Week in Review for the week of October 18th. I'm Fritz Folts, the Chief Investment Strategist, and with me here today once again is Steve Cucchiaro, President and Chief Investment Officer here at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be revisiting our concept of what we refer to as the seasons of the market, which we believe can be a helpful way to describe changing economic and market cycles. Before we get to that, quick update on the markets this week. The October rally in equities this week had the S&P 500 index closing in on its early September high water mark. However, the rally, which is being supported by the ongoing global recovery from the coronavirus pandemic, now seems to be running up against the prospect of sooner than expected tightening of monetary policy to curb inflation. Increasing inflationary pressure is coming from a dramatic increase in energy costs and continuing disruptions in global supply chains. The consumer price inflation in the U.S. is running at a 13-year high and well above the Federal Reserve's target. The Fed is also preparing to begin to taper its $120 billion a month of bond purchases, and investors are continuing to debate how soon the Fed may need to begin to raise short-term interest rates. The consensus on Wall Street has shifted forward now, with market participants expecting the Fed to have to increase their short-term interest rates twice in 2022, which is much sooner than the consensus was earlier in the year. And so, the question that investors must ask themselves now is, what will be the potential impact of Fed tightening on the capital markets, particularly after a decade of accommodative monetary policy? So, Steve, let's dig into our topic for today, which is the seasons of the market. We've spoken about market and economic cycles in the past in terms of the seasons, found it to be a helpful way for clients to think about economic and market cycles. So maybe the best thing to do would be to just give an overview of the seasons of the market to get us started.
Well, Fritz, I do think it's a very helpful framework. And if we just think about seasons in nature, knowing the seasons is very helpful to knowing what to anticipate and what comes next. And similarly with the markets, think about spring as an economic recovery. The economy is recovering from a recession or winter, and it's now picking up. Think about summer as an economy that's now overheating. Think about fall as an economy that's beginning to slow down. And think about winter as an economy that's now actually got some kind of negative growth or recession or, at worst case, depression. And so you can go through the seasons, and they do fall in sequence most of the time. And they are driven by a series of causal factors that include economic growth, inflation, and monetary policy by the Fed.
Perfect. So now we'll peel away that onion once and look at which asset classes tend to do better depending on which season of the market we happen to be in.
So if we start between winter and spring, we have a period where the Federal Reserve Board is adding lots of monetary stimulus to try to get out of the recession, try to get economic growth going, and to allow inflation to come back to target. And that's a period that's very conducive for both equities and bonds. Bonds, which have done well during the winter months as interest rates came down and they're not ready to go up again. And equities, because investors anticipate things are getting better. Now let's move from the period between spring and summer. Now we've had prolonged economic growth. This continues to be favorable for equities. We have continued monetary stimulus. But inflation starts to pick up, which is not so good for bonds, but is very good for real assets like commodities and gold. Now, as we move from summer to fall, we have a different period where the Federal Reserve Board typically, sometimes earlier, sometimes later, recognizes that the economy is overheating, inflation is getting out of hand, and it's time to reduce monetary stimulus and pull back on credit. So you get a credit tightening. This is not good for equities. Commodities can continue to do well, feeding off the inflation that was created in the period before, but this is where it's good for investors to start raising cash that reflects well in a credit contraction when cash is more deep. And then when you move from fall to winter, this is a period, again, not great for equities because the economy is now slowing down or going into reverse. Not great for real assets anymore because Federal Reserve Board has tightened monetary policy and stopped demand for commodities and real assets and raised real interest rates. But starts to be good, not just for cash, but also for bonds as interest rates start to come down again. So you have these cycles. And with these cycles, you can help build a framework to know better what to expect next.
Perfect, which leads us to our next item, which would be to talk about exactly where we are in terms of the seasons of the market now, where we might be headed, and importantly, what are the implications for investors?
So right now we've had a period of great performance in equities, and over the past year, great performance in real assets. So clearly we're between spring and summer. We would argue, and our models would indicate, that we're now in the early to mid stages of summer, where inflation is percolating and rising more than people expect. The Federal Reserve Board, however, has held back and continues to provide the extraordinary stimulus. And it's not until perhaps the next Fed meeting, which is on November 2nd and 3rd, that we might hear the beginnings of a plan to start withdrawing stimulus. So we are very close to summer. And what we should anticipate is what follows summer, fall. And in that case, there'll be a time where equities will peak, real assets could continue to do well, but it'll be a time to start raising more cash. Now, I want to point out from a risk management viewpoint in human nature that when you're in the winter, that's when investors are most concerned about preserving capital and managing risk. But if they think about the seasons, that's when you should start to anticipate spring is coming and start to get more aggressive. So it's just the opposite of human nature. Similarly, in the summer, people are so used to the equities doing so well, it seems like it'll last forever. We'll have an endless summer. And yet it's precisely when investors should be most concerned about risk management, because it's looking at what happens next. And we know that after summer comes fall.
Excellent. That's terrific. And hopefully that the analogy of using the seasons to describe market cycles has been helpful. And that will do it for us, for Steve and me, this week. We'll be back next week with another edition of the 3Edge Week in Review. Remember, all of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.